Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is the first in a series of 2 webinars titled Top-Down Analysis or How to Prepare for the Trading Day. And we will talk about a topic that is very important, preparation for the trading day. There is an old adage, if you fail to plan, you plan to fail. It is all about preparation. Nothing is guaranteed in trading, but the odds of success will be greater if you take the time and analyze the market before your trading day starts or a trading week starts. And in this webinar, we will go through the process of analyzing balance between supply and demand captured from currency futures market so that you can trade Forex using that information. Also, we will talk about important reference points on charts that are important for either day trader or trade operating on any other time frame. All ideas discussed in this webinar were somehow used for trading either from me or students of my educational groups, so all ideas have practical application. They are based on practical experience. Now we are getting started. And traditionally, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using historical backtest before putting real money at risk. Now we are ready to start. And let's start with key principles of preparation. Number 1 is the trading plan is not about the market, it is about your actions. It is also not about a financial plan. You are not expected to know how much will you earn in the market. It's almost impossible. You never know how much the market will give you. It is not a plan for financial results, nor a plan for predicting the market. Market will come to the point X, then it will be ready to come to the point Y, Z, and etc. No, it is about your actions. It's the only point that we can focus on. We know that we will execute breakout momentum trades if market will come to the point X. We will try to capture pullbacks in case the market comes to the point Y, and then we will try to put up a position trade in case market comes to the point Z. That can be the trading plan. And of course, elements of the trading plan can include details of execution. How exactly are we going to enter? Where should we place our stop? Where should we place our take profit? And etc. And the number 2 point is that preparation guarantees nothing. Yet it increases the odds of finding good trades. And you know, preparation is sort of a lifestyle. Once you start doing the preparation, you just can't stop because you feel that preparation is what professional traders do. You know, guys from hedge funds, they wake up early and they start their day with a preparation. They come to the workplace and they start examining charts, examining news. They want to know what has happened overnight. And it is pretty much professional behavior. And the principle number 4 is that you can make your own checklist and not to rely on your memory. Too often traders think, oh, I know everything, I don't have to write anything down. Or they may think that nothing has happened, I don't have to write anything down. But thinking so, you can miss some very important points, any nuance, any observation that can completely change your view on the market, and therefore it can help you filter some bad trades or find good trades. And the number 5 principle is it is essential to track your success. I don't mean that you have to track your financial results because you see it on your trading account. I mean that you are expected to ask a question. Have you been able to execute upon your trading plan? Were I successful in following my plan? Can I grade my success in following my trading plan? It's very important because all professional traders with much experience, they talk about following the plan. It is not about the money, it is about following the plan. And one of the first things and most important things that you have to understand pretty early in trading is importance of keeping a journal. Traders with more than 30 years of experience do it consistently. The journal doesn't mean that you put your trades with time and price. It requires to write down the thoughts about the market, your feelings about the market, your trading ideas, and writing down these ideas will help you learn and look how many of your ideas work. So it really helps you shorten your learning curve. So trading journal is not just a statement or a trading log with time and price. It is your analysis, your thoughts, your ideas aligned with the trading log, so that you can see how good your trading was in the past. So your trading journal can consist of three parts, which are analytical part, psychological part, and the trading log. Analytical part can include your ideas, thoughts, your trading hypothesis, your view on the market. And finally, psychological part of your journal can include your feelings, your emotions, your expectations, your state of mind, and all this information has to be aligned with your trading log. Working on analytical part of our journal, we can easily write down something like this. Market is weak or strong, or market is preparing for the correction, or market is trending. And it is interpretation, but it is not that easy. We don't have only to write down interpretations, but also the facts that we were relying on building that interpretations. And I strongly recommend you to have two columns. The first is facts, the second is interpretations. And what is a fact? For example, the fact can be the following: the new extreme for this certain period, or for example, market has shown us that certain level was rejected several times, or open interest and volume from corresponding future contracts, they have increased. That is a fact, that is not an interpretation. As for interpretation, you see it in the right column. Market is weak or strong, we see strong support, and etc. So we have to know how we make decisions. We have to know how we really generate our trading ideas. We have to know the underlying process, because if we know that, we can change something in this process and improve this process. If we don't know, we just face our results, our financial results, and we can't easily capture what is going on. So writing down facts and interpretations separately in different columns will help you catch your mistakes in thinking, and eliminate them from your trading. And as I have said before, it's better to create a checklist rather than to just rely on your memory, because we tend to forget anything, we tend to skip anything if we don't feel that it has importance now in the current market conditions, but in fact it can be important. And number one is fundamental background. The fundamental background is number one in any analysis, because if we start with it, we will not skip any important news. Because if I know if there are important news releases ahead, I will know pretty much clearly that volatility will be increased in the market at that time. And market will manipulate the price to both directions, collect stops before that release. And it will be very difficult for the day trader to trade in such conditions. Well, of course it's not impossible, but I would personally avoid doing that. Number two is supply and demand. If I see any significant shifts in supply and demand, I will take them into account because they can allow me to build decent trading idea. To do that, I analyze COT-reports and daily bulletins from CME. I will explain you a bit later what it's all about. In a nutshell, it is information captured from futures contracts. We have a spot market, which is Forex market, and we have a futures market, which is derivative from the Forex market, and it is transparent market with volume and open interest published daily on a website of Chicago Mercantile Exchange. Number 3 is a market sentiment. Well, it's not a very meaningful thing, but it can be also important because when the market is optimistic or pessimistic about the asset, it can be the piece of information. You can analyze news, or you can use any indicators of market sentiment published by different websites. It can also be important. Number 4 is seasonality. Not only commodity futures fall into seasonal windows, but also currencies, stock indices, and any other financial assets. For example, we can have strong bullish expectations about any asset in October or in November or in December, and you can take them into account because it's just a statistics. It is not something very important. It's not more important than your technical analysis, but you can take this fact into consideration. And number 5 is a relationship between price and important extremes. In other words, have we seen any breakouts of important extremes recently? I mean, a week ago, 2 weeks ago, or 2 days ago? This information can be important because it is often a sign of other time frame buyer or seller involved in the game. And the number 6 is a relationship between price and other reference points like moving averages or any levels or any other levels that can be important that you can monitor. And the moving average is the first that comes into mind. And number 7 is correlation. To use correlation, you have to know that the broad market, for example, is going to one direction. All currencies are weakening against the American dollar, and one currency is going in an ascending trend against the American dollar, and you know that it is an anomaly that can be eliminated from the market over time. So you can short this rising instrument, you can go short, you can search for short positions, but it's not that easy because we don't really know which instrument is lagging and which instrument is leading, and we can easily fall into the so-called correlation game. Well, I use it very carefully, and it's not number 1. I have put it in the last position here in a checklist. Yet correlation can be successfully used in statistical arbitrage or pairs trading, and maybe we will dedicate separate webinar to this topic. Following checklist that you have seen on the previous slide, we can start our preparation process with watching economic calendar. To do this, you can follow the link shown here is www.exness.com/tool/calendar, and you see different news releases here. And all important news releases are marked with different color. And with different color we can see the relative importance of such news. For example, here we have high level of importance because we had Bank of England rate decision. Rate decisions from central banks are really important for the market because they affect rates of major currencies. And we have to be aware of the indicators used by central banks or Federal Reserve for changing interest rates or leaving them unchanged. For example, here we have also high level of importance when we see changing non-farm payrolls. It's the first Friday of the month, and unemployment rate. And before that release and during that release, volatility can increase substantially. I will show you now a couple of examples from the last Friday of the month. Here you see the 15-minute chart of American dollar versus Japanese yen, and that is a period of news release. So you see that market has become very manipulative, it has become very volatile, and you see it on every time frame. So if you consider going with the price, if you consider placing any trades, you see that you are going to be stopped out very quickly within this window, and you have to wait for at least 1 or 2 hours, or maybe 30 minutes, I don't know, but no less than 1 hour before putting any trades. And possibly you have to stop your operations 1 or 2 hours before the release. Does it mean that it is always impossible or difficult to trade during news announcements or news releases? As you see from this example from Australian dollar versus American dollar, if you know important reference points, you can use this volatility in your favor. For example, we have seen initiative break here, and we could build a support area, and once market has been pushed down here to support area, we had a good trade location for a pullback trade, because before that market was showing us pretty strong conditions, so it was pretty strong trending market. And just a minute, I will show you the strength. Let's go to, I don't know, hourly chart, and you see that market was going up without any correctional moves. The correctional moves were not very deep. This is a sign of strength, and eventually the support area was protected. I don't know whether it will be protected one more time, because for now this position doesn't look good anymore, but before the day closes you could establish a good long position, and you can take more than 3-to-1 profit-loss ratio in a trade. And the next important piece of information is open interest and volume. But we can't track volume and open interest from interbank Forex market directly, because there is no centralized exchange for this market and therefore no centralized reliable data. But there are derivatives that indicate major shifts of supply and demand, and it can be visible for futures market. Currency futures are traded on Chicago Mercantile Exchange, which publishes data for open interest and volume daily. And besides, we can view the so-called COT-reports to understand who is involved in the process. COT means commitment of traders. Volume is great on the spot market, and major players of the futures market are hedgers and speculators. If something is happening in the spot market, it will be automatically registered in futures market as well. And before we proceed, I want you to look at this slide where I have put a couple of charts. The left one is Euro versus American dollar, the right one is Euro currency future. Charts are similar. Quotes of Forex currency pairs and price of futures contracts differ in certain amount of pips calculated by the forward point, but in whole it is similar. So you can analyze one market and analyze the second market automatically. And the next important definition that will help us go through this webinar is COT, or commitment of traders. It is a report published on a weekly basis on Fridays by CFTC Commission on cftc.gov website, and it shows open interest with totalization who are holding positions. They are commercials, large traders and small speculators. Primary source is cftc.gov, as I have said, and a secondary source can be timingcharts.com. For my trading I use timing charts because it shows visual data, and it is much easier to analyze visual data than numbers. And open interest, it is a number of contracts that are being held overnight. Now let's go to the primary source and look how it looks like. That is cftc.gov website, and here is a commitment of traders report. I can click here and view the weekly report. What do we see here? we see different instruments, and we have to choose here the short format of Chicago Mercantile Exchange. And we see here different instruments, different trading instruments. For example, milk, butter, it's not what we are analyzing. We need currencies, and here are currencies. You see the Canadian dollar, for example, that is Canadian dollar future, Swiss franc, Mexican peso, British pound sterling, and you see the total long and short open interest, non-commercial, commercial. So that is primary source. It's pretty difficult to analyze that information. That's why I prefer to use timing charts. This is a free website that builds this information in a visual mode. For example, if I choose the currency future from euro, I use COT, I push COT button, and that's what I get. Okay, we are now on website www.timingcharts.com. First of all, I want to pay your attention to this button that is linked. So we have to analyze linked contract because we have a couple of contracts here, or several contracts: March, June, September, December. Every futures contract has its time for expiration, and we have to analyze the linked contract. This is the first thing. What do we have here? We have here several lines. The blue line is commercial traders, the red line is small specs, and the green line is large traders. And you see, large traders, they are speculators. They go with the price most of the time. Commercial traders, they go against the price most of the time, and it's easily explainable because they are hedgers. They are not expected to earn in this market. This market is used for hedging or physical delivery. They use, for example, they use amount of euro in their business, so they need some euro and they buy more and buy more and more as the market goes down. Okay, what can we really see here? And the first thing that we have to pay our attention to is accumulation. Following this chart, we see that nothing was happening here starting from September to late October, but then market has broken out to the downside, and we see that every week new positions or new players, they were stepping in the market. And it is not just 1 week, it is a process of several weeks. And finally, we have information for the previous Tuesday, that is December 1st. So all this time it was accumulation. Later on, we have seen significant short coverage rally here, but before that, once we see 3 weeks of accumulation, for example, we have plenty of opportunities to go short with this market with not very elongated targets, but it is a signal for short position. Okay, so you see here the chart of euro versus American dollar, and as I have said, COT-report is not published in real time, so we have 1 week. It is lagging. It is published by the result of Tuesdays. For example, we see at November 16th, we see from November 10 is here. We see that we had 3 weeks of accumulation: October 27, November 3rd, and November 10th. 3 weeks of accumulation. So it's pretty significant shift in supply and demand. And we see this information we see this information here on Friday or on Monday, so we can plan our short positions. How we can do that? For example, the easiest way is, I don't know, again we can build moving average, for example with parameter of 35, or let's take something greater like 150, and that is our trade location, one price. And as our trade location, we can start searching for a short position here. We can start searching for a short position here, here, and we have several opportunities to go short here. Not very big targets, but we have several targets here, and you know, the frequency of winning trades can be pretty successful here. Please look at the current chart with British pound. So we have seen also here that we had 3 weeks of accumulation. We have 3 weeks of open interest increasing here, and the market is consistently leaning to the lower side of this bracket or the trading range. Let's go to timing charts again and search for British pound here. Okay, what do we see here? We see now 4 weeks of published open interest here, and the result by December 2nd is that open interest is not increasing, but for the previous 3 weeks it was increasing. November 10th, November 17th, November 23rd. And let's go to the chart and see what was happening on November 23rd. It is here, and we have seen the report here. So we have seen that for the previous week, open interest was increasing. It can also give us the clue for going short here. So we can start searching for short positions on a pullbacks here, for example. So you see the pretty good trade is a very good trade with a breakout momentum trade or a pullback trade when the price goes outside the range. It's pretty good rally. Can we search for short positions here? I'm not sure, because open interest is not increasing anymore. Okay, what about Japanese yen? We have the Japanese yen future, which is Japanese yen against American dollar, while on Forex we have dollar versus Japanese yen. So charts are going in the opposite direction. And the situation is pretty interesting here, because we have open interest rising here for a period of 5 weeks, so it's not declining here, and it's very important. For December 1st, it is not declining, it's not decreasing. So you see, and which is more important, that market is going in a sideways action. We can see the breakout followed by this sideways action, because as I have said in previous webinars, it is more good to search for trading ranges to find a destination trade, to find a trend, because we want to go one step ahead of the market. And let's look what was happening before the December 1st on the Japanese yen. Okay, so the chart is opposite here. That is December 1st. And I would say that we can search for long positions on American dollar versus Japanese yen. So we have a couple of levels here, or just one significant level here for going the breakout momentum trade, or we can search for a pullback trade. Once we have false breakout, for example, it goes to pullback, we can capture a pullback and go with this trend. Something like that, because we have seen accumulation within this range. And that's why it is pretty understandable to see the breakout to the upside here and the breakout to the downside on the futures on the Japanese yen. Let's get back to the previous slide and go once again through these points. First of all, any fundamental analysis or any top-down analysis starts with news releases. We watch economic calendar and see what news are going to be released, maybe in a few days or within this week. After that, we can go to COT-reports, to timing charts, and watch whether we have significant shifts in supply and demand for the period of last 2 to 3 weeks, 2, 3 or 4 weeks, the more the better. And in next webinar we will pay more attention to the charts, to reference points that can be used for analysis. We will talk about relationship between price and important extremes, and relationship between price and moving averages and other references. So that is very important. But before we go to the charts, we want to see what is happening outside the chart. What is happening with open interest and volume. If you have any questions or comments to this video, feel free to leave them below and I will do my best to answer all of your questions. Please be specific in your questions to receive a good answer. Good luck and see you in the next video.